Most Bitcoin holders do not sell for a bad reason. They sell because they never built a rule for when selling is actually correct. And that gap is where regret lives. Today, you get 3 rules. And by the end of this video, you will know exactly which one applies to you right now. Every holder who has ever sold too early or held too long made that decision without a fixed test to check it against. They relied on how the chart looked that morning, or how a headline made them feel that afternoon, and both of those inputs change by the hour. A rule, by definition, does not change by the hour, which is exactly why it works when feelings do not. This is not financial advice, and nothing in this video should be treated as a recommendation to buy or sell any asset. My job is to give you a framework you can apply to your own position, using verified data and nothing else. This framework does not care what the price is doing today, and it does not care what your favorite account on social media said this morning. It only cares about 3 specific conditions inside your own decision making. If none of those 3 conditions apply to you, this video gives you permission to do the hardest thing in this asset class: nothing. Doing nothing on purpose and for a documented reason is a strategy, not a failure to act. Each rule below follows the same format, so you can apply it without rewatching the whole video later. First, the mechanical question the rule asks. Second, the verified data relevant to answering it honestly right now. Third, the bear case, the way this rule could go wrong or be misapplied, because a framework that only shows you the bullish side of every argument is not a framework. It is a sales pitch, and this video is not one. Let's start with Rule 1. Rule 1 is called the thesis check. Before you consider selling any Bitcoin, you have to answer one question honestly. Has the reason you originally bought this asset been proven wrong, or has the price simply gone down? These are not the same thing, and confusing them is one of the most expensive mistakes a long-term holder can make. Here's what a real price event looks like, using verified numbers. Bitcoin peaked near $126,000 in October of 2025, and by mid-2026, it had fallen roughly 52% to the $60,000 range. That is a real painful drawdown, and it is exactly the kind of number that makes people question everything. A drawdown of that size is not unprecedented, and history is useful here precisely because it removes emotion from the comparison. Bitcoin fell from roughly $19,000 to around $3,200 during the 2018 cycle, a decline of more than 80%, and it recovered years later to make new highs. It also fell more than 75% from its 2021 peak before the current cycle began, and both of those drawdowns felt at the time like the thesis was ending. But a drawdown is a price event, not a thesis event. The original thesis behind holding Bitcoin as a scarce non-sovereign asset rests on 3 components: fixed supply, decentralized issuance, and growing institutional and sovereign adoption. None of those 3 components changed during this drawdown, and that distinction is the actual test. Walk through each component honestly instead of assuming it still holds. The supply schedule is fixed by code, and no drawdown in price changes the 21 million coin ceiling or the pace at which new coins are issued. The decentralized issuance model, meaning no single company or government controls new supply, has not been altered by any event in this correction, and that fact is independently verifiable on-chain by anyone watching. Adoption is the component people worry about most, so it deserves the closest look. Even during the sharpest part of this drawdown, spot Bitcoin ETF products, corporate treasuries, and at least one pension fund publicly disclosed continued exposure, which is a different pattern than what happened during prior bear markets when institutional participation was close to 0. That does not guarantee anything about price, but it is a structural difference worth naming plainly. Now the bear case, because it belongs in every single block of this video. A thesis can genuinely break. If a major government successfully banned Bitcoin custody at scale, if the network suffered an unrecoverable security failure, or if adoption reversed for multiple consecutive years, that would be a real thesis failure, not just a price event. There's also a subtler version of thesis failure worth naming, because it is more common than an outright ban. If the specific reason you personally bought Bitcoin was, for example, a belief that a particular country would adopt it as legal tender within a fixed time frame, and that time frame passed without it happening, your personal thesis failed, even if the broader scarcity thesis did not. Rule 1 applies to your stated reason, not to the generic reason other people give. Right now, the verified data points toward the broader thesis holding rather than breaking. United States spot Bitcoin ETFs recorded about $4.6 billion in net outflows in June of 2026, the largest monthly redemption since these products launched. Over roughly the same stretch, large wallet addresses that on-chain analysts call whales accumulated more than 270,000 Bitcoin, worth around $16 billion and $700 million. That divergence is unusual enough to name specifically. Institutions selling through the ETF wrapper while large private holders accumulate directly on-chain is a pattern some analysts associate with prior cycle lows, though I want to be precise that association is not causation and no one can verify that in real time. Exchange reserves, the amount of Bitcoin sitting on trading platforms available to be sold quickly, were also reported near 7-year lows during the same period, which is consistent with coins moving into long-term storage rather than toward an exit. That is not proof of anything about the future, and I want to be honest about that limitation. But it is a real verified divergence between short-term institutional money leaving and long-term holders adding, and divergence like that is worth tracking, not predicting from. So rule 1, in one sentence: if your thesis, your specific stated thesis, has not been falsified, a price decline alone does not satisfy it, and you keep holding until it is answered honestly. Rule 2 is called the position check, and it has nothing to do with belief. This rule asks a purely mechanical question. Is your position sized in a way that a normal, historically ordinary price swing could force you to sell against your will? If the answer is yes, that is not conviction, that is risk of ruin wearing a conviction costume. Leverage is the fastest way to turn a normal drawdown into a forced sale. Bitcoin futures, open interest, the total value of active leveraged contracts, peaked near $31 billion and $300 million in late May of 2026, and by mid-July it had fallen to around $21 billion and $600 million. That drop did not happen because traders calmly changed their minds. It happened because leveraged positions were liquidated when price moved against them. Funding rates add a second, quieter mechanism worth understanding. The Bitcoin funding rate, the periodic fee traders pay to hold leveraged long positions, sat only slightly positive at a small fraction of a percent in mid-July, which signals a market without excessive leveraged bullishness right now. That is a healthier reading than the elevated funding rates seen near prior tops, and it matters because crowded, expensive leverage is usually the fuel behind the sharpest forced selling cascades. Here is the mechanical trap in plain terms. A trader holding Bitcoin with 5 times leverage can be liquidated by a price move of roughly 20%, and Bitcoin has moved more than that in a single week multiple times in its history. A trader using 10 times leverage needs only about a 10% move against them, which is well inside a single volatile trading day for this asset. An unleveraged holder, by contrast, has never once been forced to sell by an exchange, no matter how far the price fell. The worst outcome for an unleveraged holder is a paper loss that can recover with time, while the worst outcome for an over-leveraged holder is a liquidation that locks the loss in permanently at the exact bottom of the move, regardless of what happens to price afterward. That asymmetry is the entire argument against leverage for a long-term holder. Bear case for Rule 2. Leverage is not always reckless, and professional traders use it inside strict risk controls that most individual holders never replicate. The danger is specific to holders who added leverage during a rally out of excitement without recalculating what price would wipe them out. That is the exact group this rule exists to protect. Position sizing works the same way even without leverage. If your Bitcoin position is large enough relative to your total net worth that a 50% drawdown, which has now happened multiple times, including the move from around $126,000 to $60,000 between October of 2025 and mid-2026, would force you to change your life plans, your position is not sized for a thesis. It is sized for a bet, and the label on the trade does not change what it mechanically is. A practical way to test this without guesswork is to ask what happens at a further 50% decline from today's level. Not because that decline is predicted, but because Bitcoin has produced moves of that size before, and a real risk check has to survive the historical range, not just the recent range. If a further 50% decline would force you to sell a home, stop contributing to retirement accounts, or take on debt, the position fails Rule 2 regardless of how strong your thesis is. That single stress test catches most of the position sizing mistakes this rule is designed to catch. History has already run this exact experiment more than once, and the lesson holds regardless of which cycle you look at. Sharp single-day drops tied to sudden regulatory news, exchange failures, or cascading liquidations across the derivatives market have repeatedly wiped out over-leveraged accounts within hours, while unleveraged holders who experienced the identical price move on paper were still holding their full position the next morning. The asset moved the same amount for both groups. Only one group was forced to realize the loss permanently. So Rule 2, in one sentence. Check whether your position size or your leverage, not the market itself, is the thing capable of forcing a sale. If so, the fix is resizing the position, not necessarily selling all of it. Before Rule 3, I want to show you something practical, because Rules 1 and 2 both depend on having real data instead of guesses. I built the Bitcoin Holder's Bible specifically to walk you through both of these checks, the thesis check and the position check, with historical drawdown tables and the exact on-chain metrics Sirius holders track instead of the price. It normally sells for $97, and if you are watching this video, you can get it today for $47 using the code DIAMOND50. This is not a donation, and it is not charity. It is a direct exchange. You get a complete framework for holding through cycles like this one, and this channel gets the support it needs now that advertising revenue is no longer part of how we operate here. It also comes with a straightforward money-back guarantee, so the only thing you risk is a few minutes of your time. Inside, the thesis check comes with a worksheet for writing down your specific reason for holding before the next drawdown makes that memory unreliable, because memory under stress is one of the least trustworthy things in finance. The position check comes with the same 50% stress test explained a moment ago, built out as a simple calculation you can run in a few minutes with your own numbers. Neither section requires any background in trading or on-chain analysis to use correctly. I see the diamond, and if you have made it this far into a video with no hype and no price targets, you likely already think in these terms too. Rule 3 is called the sleep check, and it is the rule most holders skip because it sounds too simple to matter. The question is direct. Is this position costing you sleep, costing you your relationships, or costing you your ability to function normally during an ordinary day? If the answer is yes, that is a signal no amount of on-chain data can override. The Crypto Fear and Greed Index sat at 26 in mid-July of 2026, solidly inside what analysts label fear territory, even as the price had just recovered several percent on the week. That gap between a positive weekly move and a fear reading matters because it tells you the emotional environment right now is more volatile than the price chart alone suggests. This is exactly the environment where Rule 3 gets tested. A low fear reading alongside a recovering price is a specific, recognizable pattern, not a coincidence. It means most participants are still bracing for further downside, even while the immediate price action improves, which historically produces exactly the kind of whipsaw price action that punishes emotional decision-making the hardest. Holders who are already stretched thin on Rules 1 and 2 are the ones most likely to make an irreversible decision during exactly this kind of week. Here is why this rule is not soft or unscientific. Chronic stress from watching a volatile asset has measurable effects on decision-making, and research on financial choices made under stress shows a consistent pattern. People under sustained anxiety systematically choose short-term relief over long-term outcomes, even when they know better. That is not a weakness of character. It is a documented feature of how attention narrows under perceived threat. This shows up in concrete, checkable ways, rather than as an abstract feeling. Checking a portfolio balance more than a handful of times per day, losing sleep specifically on nights when the price has moved sharply, or noticing a change in mood toward family members that tracks the price chart are all measurable behavioral signals, not vague impressions. None of these require a diagnosis to take seriously. They only require honesty about the pattern. Bear case for Rule 3, because this rule can be misused as an excuse. Some holders will use momentary stress to justify selling a fundamentally sound thesis position during a completely ordinary drawdown, when the honest fix is reducing position size or limiting how often they check the price, not exiting entirely. The rule is meant for genuine, sustained impact, not a bad afternoon. The distinction is whether the stress is proportional to the first two rules. A holder who is sized correctly, whose thesis is intact, and who still cannot sleep after doing everything right, may simply not have the temperament for this asset class, and reducing exposure is a legitimate, honest response. A holder who only panics during red candles or headlines and calms down within days is likely experiencing something Rule 3 was never built to solve. There's a practical middle path between holding everything and selling everything, and it is worth naming directly. Reducing a position by a fixed amount, moving it into cold storage to reduce how easily it can be checked, or setting a specific limited schedule for looking at price are all interventions that address Rule 3 without touching Rules 1 or 2 at all. The goal of Rule 3 is never maximum exposure. It is exposure you can hold without your life quietly deteriorating around it. So, Rule 3, in one sentence, if the position is genuinely costing you sleep, relationships, or basic functioning even after the first two rules are answered correctly, that is real information. Reducing exposure to a size you can hold calmly is not failure. It is risk management applied to the one variable spreadsheets cannot measure. Put the three rules together and you get a decision framework, not a feeling. Rule 1 asks whether the thesis is actually broken, not just the price. Rule 2 asks whether your position size or leverage, not the market, could force a sale against your will. Rule 3 asks whether the position is costing you sleep, relationships, or basic functioning, even after the first two rules have already been answered honestly. If all three come back clean, thesis intact, position sized honestly, sleep and life unaffected, you have your answer, and it is the hardest one to act on. Continue holding and stop relitigating the question until something material actually changes. Notice the order matters as much as the content. You check the thesis first, because if it has genuinely broken, nothing about position size or sleep quality matters. The reason for holding is already gone. You check position size second, because a thesis can be perfectly intact, while a poorly sized position still forces you out at the worst possible moment through no fault of the thesis itself. Only after those two are answered, honestly, does Rule 3 become relevant, because sleep and stress caused by a broken thesis or a reckless position size are not really a Rule 3 problem. They are Rule 1 or Rule 2 problems, wearing a Rule 3 symptom. Fixing the wrong rule is how holders end up making the same mistake twice. First selling out of panic, then buying back in out of a different kind of panic. The order exists specifically to prevent that cycle. If any single rule fails, you now know exactly which lever to pull. Updating your thesis, resizing your position, or reducing exposure for your own well-being. That is the actual difference between a holder and a gambler. A gambler reacts to the last candle. A holder has 3 rules, checks them in order, and only acts when one of them is genuinely triggered. None of this requires certainty about where the price goes next, and that is deliberate. The entire value of a rule-based framework is that it produces a consistent answer regardless of whether the next candle is green or red, which is the opposite of how most holders currently make this decision. That consistency is the whole point, and it is the difference between a decision you can defend to yourself in a year and one you cannot. If you want the complete version of this framework, with the historical drawdown tables, the on-chain metrics worth tracking, and the worksheets for running all 3 checks against your own position, that is exactly what the Bitcoin Holders Bible was built to do. It is normally $97. Today it is $47 with the code DIAMOND50, and it comes with a straightforward money-back guarantee. I see the diamond, and if these 3 rules made sense to you, you already know which kind of holder you are.